Prices in Sydney are starting to decline for the first time in a long time, and as you can see, and as you're going to see over the next 12 months, prices in Melbourne are beginning to do the same thing. Now, that can scare the shit out of a lot of us. That can scare off a lot of investors, particularly when the media looks as dire as it does right now. But in today's video, I'm going to explain a number of things that hopefully will put you at ease, that will help educate you in a more meaningful way, looking at longer term trends as well as the history, not over a very short period of time like the media is at the moment, but over a much longer period of time. I'm going to talk about cycles and timing as well as history in a big way. I'm going to talk about averages and taking a longer term approach to investing and not looking at as much what's happening in a month-to-month basis or an annual basis, which is completely outside of your control. And I'm going to also talk about what you can do about it, how you can take advantage of it, and what's coming next. So my name's Ben Everingham and I'm the director here at Pumped On Property. Now, as a business, we've helped buy over $300 million worth of property. So if you're interested in learning from our experiences, we do a heap of videos and a podcast each week. You can subscribe to the channel here where we talk about these sorts of things and so many other things that investors we need to know about. The first thing I wanted to discuss in today's videos in terms of how long prices in Sydney will decline is cycles. Now, we all know that property goes up and down in value, or for a while in Australia it's felt like it hasn't gone down. So we get used to it going up, and this is called recency bias, and it is a huge black spot that a lot of investors have. Tony Robbins talks about it in one of his books, Money Master the Game, and it is really a black spot where we look at recent history, what's going on right now, what's going on in the last 12 months, what's gone on in the last 5 years, and we go, that immediate past is going to represent the future, and then all of a sudden property prices go flat in an area or they start to decline, and we all back up against the wall and we either go into fight or flight mode and we follow the herd. But unfortunately with the herd, most of them are walking towards the pension. 80% of Aussies end up broke and not being able to finance their own retirement. So why the fuck would you follow the herd? You know what I mean? Unless that herd is the super wealthy or people that are already financially independent, you know, they're the ones that you should be getting your information from, and you should be getting a more balanced story. Remember, most journalists are just struggling to keep a job and will say anything they possibly can right now to get media attention and to keep making the paycheck that in 5 or 10 years won't even exist anymore. So things happen in terms of cycles. If you're as interested in that stuff as I am, check out Fred Harrison's book, The Power in the Land, where in the 1980s he called the 1990 Depression. In early 2000s he called the 2007 recession, and that was in another book that he wrote called Boom and Bust. Again, what I love about Fred is he published these books 2 to 7 years before the recessions even came, calling them the exact month, the exact year, and exactly what was going to happen. So know your history, and the way that Fred knows his is he looked at 300 years of booms and busts in the UK from a property and, since there was a share market perspective, and he overlaid what has become known as sort of an 18-year property cycle, which is the big picture. Fred also inspired another Australian guy called Phil Anderson, who's an economist, to write another book called The Secret Life of Real Estate and Banking, which also looks at this bigger, longer term cycle in America, which he found loosely matched what happens in Australia and the UK over the last couple of 100 years. So for data geeks like me, that's a great resource. I think understanding your history will help you not predict your future, but understand how to read what's happening right now and what to do about what's happening right now a bit better. Other people say there's 7-year cycles, so since the last GFC till now, we're about 7 odd years into it, maybe a little bit further, and you know, for some people, you know, that 7-year cycle is taking place exactly the way they expected it to, because they understood that this happens after a GFC. Other people believe in a 10-year cycle. Now, whether any of those people or any of those ideas are right or wrong, it doesn't matter. What matters is what you do about current market conditions and how you go from where you are to financial freedom, which is the only reason you start investing in property or you start investing in shares or bonds or whatever it is that is your thing. So just remember that everything you are trying to do is get the highest return on your investment with the lowest amount of risk in the safest possible way. So cycles are important, and right now Sydney and Melbourne, if you knew your history, are at the perfect stage right now to be doing exactly what they're doing. If you watch my videos from 2 years ago, I was saying exactly this, that Sydney and Melbourne would be at exactly this point right now. It's not rocket science, it's not hard to predict that. Markets can't keep going up by 10 or 15% per year like they did for a 5 or 6 year period up until this point. At some point it becomes unaffordable, money becomes harder to get, or the wind changes blowing in the direction where the herd is going and things change. And it doesn't mean that property in Sydney and Melbourne's a bad investment. It doesn't necessarily mean that property prices are going to go back by 10, 20, 30, 50% in a short period of time. It doesn't mean that if you bought in the last couple of years, you bought a dud and you're never going to make money on Sydney again. But what it does mean is there might be a temporary recorrection which could last 6 months, it could last 3 or 4 years, it could last 10 years. But if you look at your long-term averages in Sydney, when these corrections have come through the way that they are at the moment, sometimes they're severe, sometimes they're not. I don't think they're going to be that severe personally. I could be completely wrong. I definitely don't have a crystal ball. But I don't think things are in that bad a state. I mean, they're not in the best state they've ever been in either, when your average income is 13, or your average home price is 13 or 14 times the average income. That's certainly not normal. But there's a lot of positive things happening as well, which the media isn't talking about right now. So if you've bought in the last couple of years, which I would call like a winner's curse phase, which is you probably paid more for the property in Sydney, and if you've bought in the last 12 months in Melbourne, then you should have. But your investment strategy, because you bought your own home or an investment, is a 15 to 20 year one, then don't stress about what's happening right now at all. Don't stress about the short-term declines in the values of properties. As long as you can keep making your repayments to the bank, they're not going to come and take the property off you just because it's in negative equity 5 or 15 or 20%. But it is really important to understand that stuff, and that over the longer term, everything is going to be fine for you. Property prices in Sydney in 30 years from today will seem ridiculously cheap. It was only 50 years ago that my grandparents bought their first property on the northern beaches for $2,000. And it was only 25 years ago that my parents bought their first property on the southern beaches of Sydney for $70,000. So things change. Inflation increases the value of assets over time and reduces the value of the dollar over time. So, keep putting your money away. Don't stress out about things too much. Make sure you've got good employment. Make sure you can cover your repayments on your home, and as long as you're not forced to sell, there's no problem right now for you. Now, let's talk about the second thing, which is timing. Now, whether you believe in a 7, a 10, an 18-year cycle, it's irrelevant. At certain times in the market, it is a great time to buy. At certain times in the market, it's a great time to sell. Now, I personally sold the last of my properties in New South Wales in the very start of 2017 because I thought at that time it was a very, very good time to sell, where basically everything that I bought had doubled in value over that 6-7 year period before that. Now, the opposite is true right now. It would probably be a really, really bad time to buy in Sydney or Melbourne, knowing that based on history, when we get to this point where prices are so expensive and overpriced, there can be a short-term period of correction or a long period of not really, really good gains. And a company called CoreLogic has produced some amazing data around this. They've broken up the last 20 years and the 20 years before that into 5-year chunks, and they've compared it across all of Australia's major metro markets and regional markets, and you can start to see the pattern of when Sydney goes through or Melbourne goes through such a strong period of growth, what happens in the 5 or 10 years after that. Now, because prices have gone absolutely through the roof, and for a lot of people watching this, you'll have made some incredible gains, well done to you. What I say is don't lose that money over the next 10 years by thinking that everything you touch turns to gold. But just, know your history and remember that you know, things have been good down there for a while. They might be temporarily bad for a little while, and then they will come good again, and it's all good as long as you're a long-term investor. So timing is extremely important. Heron Todd White produces an amazing report on this each month, where they look at where Sydney, Melbourne, Brisbane, Canberra, etc., are at any point in time with their property clock. Now, it's not always perfect, it's not a silver bullet, but it does give you a good moving dial of where things are at with property prices in the major markets around the country at any point in time. And as I said, the Phil Anderson and Fred Harrison books can be a great resource, as well as the CoreLogic weekly and monthly reports that those guys do as well. So the third thing I wanted to discuss is your history. Now, because of this recency bias so many investors have, they believe, and think about Bitcoin in 2017, how it went from almost nothing to hysterical. I think mates of mine sold out at about $26,000 that just do that. You know, it went absolutely wild, and you can think about property the same way, although property takes a longer period of time to go through that cycle, where Bitcoin did from bottom to top to bottom again within 9 months. You know, property takes 7 to 18 years depending on which cycle you follow. So in terms of timing and history, there are great times to buy, and generally the best time to buy as a property investor is in the second or third year of a recession or a depression, where there's not too many buyers in the marketplace, but you're not going to have to wait forever to actually make good gains on the property that you buy either. The worst time to buy is at the very, very top of the cycle, or you know, when an asset, for example, Sydney, had already gone up by 60 to 80% in the 5 or 6 years before that. And that's why people are coming unstuck at the moment. It is a natural recorrection because those people at the very top overpay. Now, if you look at Fred Harrison or Phil Anderson's long-term 18.5-year cycle now, we're coming into a middle point, which is we've come out of the last GFC. We've had relatively good gains in terms of pockets of the Australian market, really only if you look at it, Sydney, Melbourne, and maybe the Gold Coast a little. Most other areas in Australia have sit relatively flat or gone backwards once you take out inflation. And we have this little cooling off period, which is, you know, could be described as a mid-cycle slowdown according to those guys. And then we get the second half of the cycle, where historically in Australia, the other major metro markets, like your Brisbanes, like your Southeast Queenslands, for example, start to do a lot better. And I did a video on this 18-year cycle if you're really interested in learning more about the history. But what Fred Harrison and Phil Anderson uncovered by looking at such a longer-term picture, not having that recency short-term bias, but looking at 200 to 300 years worth of data, is that, you know, there's good times and there's bad times, and things in property go in waves, and it is your job as an investor to understand and take advantage of those waves. It's not to just buy when everyone else is buying or sell when everybody else is selling, because as I said before, the masses have no fucking idea what they're doing, and they make really, really bad emotional decisions for the wrong reasons, as opposed to strategically using the cycle and history to understand what's going to come next. So I personally believe that over the next 7 years, we'll see some very, very, very solid population, job and income gains, as well as capital gains in Brisbane and Southeast Queensland. And again, if you know your history and you look at the year-on-year data, it would be very, very easy for you to understand that, educate yourself on that, and then take advantage of that yourself as well. So the fourth thing I wanted to talk about in this video in terms of how long prices will slide in Sydney or go down is just averages. Now, yes, if you look at the last 12 months of data, property prices in Sydney have gone down by 5%. If you made 80% in the last 6 years, who gives a shit? Seriously. But if you bought in the last year and you overpaid by 10 or 15%, then you might be feeling that crunch right now, or you might be just listening to the media and absorbing all the bullshit that they're saying at the moment and feeling that, and that is completely cool as well. You know, I understand it. It is what it is. But if we look at longer term averages, in the last 10 years, or Sydney has gone up by an average of, I think, according to CoreLogic, 6, maybe 7% per annum, which is exceptional. Exceptional. Like, if it can go up by 7% per annum compounded over 10 years, we're almost talking about historical prices where, you know, property almost doubles every 10 years type thing. So that's an incredible gain. If you bought at the right time, you would have realized that gain. If you mistimed it, that's cool. Get onto it next time that opportunity comes around. If we look at Sydney over the last 20 years, it's done an average of 8.7% a year or 8.8% a year per annum for 20 years. If we look at the last 46 years worth of data from Homely, CoreLogic, as well as the Australian Bureau of Statistics, we're talking about a 9.6% average increase per annum in the value of properties in Sydney. So yes, your property price has gone down by 5%. Know the future. The future is not going to be as good as the past was because prices are freaking really expensive and wages haven't increased that much. But at some point, prices will become more affordable again. And, you know, if you can get a property that goes up on average by 4.8% a year for 15 years, whatever dollar you put into the property today has turned into $2. So if you've bought $1 million property and it goes up by 4.8% a year for 15 years, you've now got a property worth twice as much, $2 million. And that is money that most of us can't save, that are never going to be able to save. And if you know your history and you know your averages, then temporary dips or booms or busts mean really nothing to you. What you're playing for is the long-term average, and what you're looking to do by buying your quality markets like Sydney, Melbourne and Brisbane is beat long-term averages in terms of performances in other marketplaces. So now isn't the time to buy in Sydney. It's clear to see that. The same is true for Melbourne from my perspective, but there are opportunities in Southeast Queensland which I think 7 years from today we'll be looking back at videos like this and going, you know, that has come full circle. So the approach I take to investing personally is a much longer term approach. Now, it's hard in a marketplace where so many of the gurus in Australia are talking about getting rich quick, where as individuals and a generation, we all want it today, and if it's not today, we want it tomorrow or this year, and people get disappointed because the performance of their property wasn't what they expected it to be within a 3-month or a 12-month period, which to me is just, you know, absolutely idiotic and just doesn't make any sense at all. But if you've got a longer term approach to property, which is something you have to develop, you know, you're always going to feel it feel it in your mind when things aren't going the way that you wanted them to. You're always going to feel it when the media is absolutely slamming property in a very specific area. But what your job is to go above that and go, the long-term averages in Sydney in the last 10 years were 7%, 20 years were over 8%, 50 years have been over 9%. If you look at 200 years of history in John Lindemann's book, Mastering the Australian Housing Market, I think property prices, according to him, have gone up by between 9 and 11% per annum Australia-wide. So not that that's going to continue into the future indefinitely, but, you know, even if we get half of that, that is very good long-term returns, and the types of returns that could really set you, your family up and future generations up. So, you know, take a longer term approach, take a breather and go, it's okay, prices could correct by 20% in 1 year. In fact, in Australia in the 1890s, property prices went down by 90% in 3 years. So it has happened before. I'm not saying that that's going to happen now, but no, it's not the worst case scenario. No, it's not the worst thing in the world if property prices were even to go down by 20 or 30 or 50%, because again, if you know your history, you know that prices bounce back, and if you know your timing, you'll be ready for that and you'll be able to take advantage of that. If you've got a 15 to 20 year approach, even with all the ups and downs in the Australian property market, those averages have still held true for 50 years. So trust that everything's going to be okay. Stop reading all the hype and start getting an educated perspective. You know, take advantage of what's happening in other areas. Just because Sydney and Melbourne, where you live right now, aren't doing what you want it to do, or the sentiment down there is low, doesn't mean that there aren't amazing opportunities that if you don't get educated on them now, 7 years from today, you will start to regret those decisions as well. It's not about flogging a dead horse in Sydney and Melbourne because that's where you live and that's where you feel comfortable about. It is being open to learning more, studying more, practicing and practicing what you're preaching, and just getting on with it and having a strategy in place to take advantage of good or bad market conditions, because great investors and the best investors do both. They don't wait for a total collapse, they also make sure that they're well prepared for the opportunities and, you know, move into and out of marketplaces as timing allows them to do that. So in terms of what's next, I think that we'll continue to see declines in the Sydney and Melbourne market for a period of time. Whether those declines are 5 to 20 or 25%, I don't know yet. Obviously, you know, unless you're looking to buy there for a home to live in, they're not the best marketplaces to be investing in right now, and the cash flow is so bad, I can't imagine why you'd want to lose money in the hope that you maybe make it up. Now, what you've got to remember about Sydney is that, yes, it's done very well for the last 6 years, but the 9 years before that were literally flat. I think it did less than 1% per year for 9 years. So for anyone that's an old hat and that's been in Sydney or Melbourne for long enough, they know that great marketplaces don't run forever. In terms of what's next from my perspective, obviously I've cashed out of the New South Wales market. I won't be touching that or the Victorian market for quite a while, personally until the next GFC. But what I am doing now is beginning to move money into the Southeast Queensland market, following the population migration, following the jobs boom that's going on up here. I just put a little blog together on my website, pulling other people's information together, and realised that in Southeast Queensland over the next 10 years there's over $43 billion worth of infrastructure and development projects already approved and in pipeline, which is just insane. And all of those projects will attract the best and brightest from around Australia. And you know, the fact that so many people are being forced out of Sydney and Melbourne right now, according to the Australian Bureau of Statistics, more Australians are moving to Brisbane and Southeast Queensland than anywhere else. So, you know, I love Sydney and Melbourne. I cannot wait to be able to buy those markets again, but I'm not going to sit here for the next 5 or 10 years while I wait for an opportunity to buy them again at the right price, which I believe will be significantly cheaper than you can buy them for right now at that time. Maybe not on the open marketplace, but definitely from the banks, from the mortgagee and possessions, you know, from the people that are forced to sell when those times do come around again. And again, if you want to understand that timing, just read Phil Anderson and Fred Harrison's books. But, you know, I'm moving my money into Southeast Queensland. I'm trying to buy as close to the beaches as possible, walking distance preferable, only houses on big piece of land or as close to the CBD as possible. As always, you're looking for properties with upside potential in terms of capital growth, as well as the ability to increase the rent return on the property. And I'm also looking for properties personally that I can add some value to as well, because obviously you want to be able to find properties that you can create value, get your deposit back as soon as possible, and, you know, decide what you do next from there. So for those of you who didn't see this coming, it's now time to take action, get your head out of the sand, stop reading all the doom and gloom, and just get on with your life. Because if you wait 2 to 5 years before you feel comfortable because the media tells you that you should feel comfortable again before you start doing anything, that's 2 to 5 years longer of your life that it's going to take to get financial freedom, and it's 2 to 5 years of your life that you can never get back again. So time in the market is the most important thing. Timing the market on top of that is the #1 rule with investing. Stay away from Sydney and Melbourne for now. Keep yourself at arm's length. You know, obviously, hopefully you don't get into a situation where you're forced to sell for a loss. There are going to be some people that are in that position, but really start wrapping your head around Brisbane and Southeast Queensland, between the Gold Coast and the Sunshine Coast. There is some incredible stuff going on up here. The average household income in Brisbane is now higher than the average household income in Melbourne, according to the Australian Bureau of Statistics and CoreLogic. So use the same skills that you use to make money down there to really wrap your head around the marketplace up here. For those of you who are interested in learning more about the Southeast Queensland market, I'd love to offer you a one-on-one strategy session with either myself or my brother Simon. Just jump over to www.pumpedonproperty.com and book in a free complimentary strategy session. If you're thinking of buying up here, we'd love to point you in the right direction. If you'd like some support buying up here, as I said, we've bought over $300 million worth of property now in Sydney and Queensland, so we'd love that opportunity to learn more about where you are, where you'd like to be in the future, and to begin educating you so that you have the confidence that you need to take action and set yourself and your family up for a brighter future, not a doom and gloomy future, because we all know that over the next 20 years, the next 50 years, we're going to go through a number of depressions, a number of recessions. You know, it's just like the tide. It comes and it goes. It is one of those things that you don't want to be caught out by, but it is also one of those things that you can take advantage of. And, you know, if you knew your stuff, now you do, or as you continue to learn your stuff, you can tread through the market with a plan, with a strategy in place, and take advantage of conditions rather than worrying about the conditions because you don't have the education to get yourself through them in the right way. So thanks for your time and attention. Please subscribe to the channel if you haven't already done it, and good luck with everything you're trying to do at the moment. I wish you all the best.